We're here with Professor Aswath Damodaran, Professor of Finance at NYU Stern School of Business. So everything looks expensive. Every asset class, QE, low interest rates, confidence, whatever it is, it looks like everything from social media to modern art, there really isn't a sector you look at and think, wow, that's been beaten up terribly. It's too cheap to resist, I have to go in. Where do you find value across all asset classes in a market like this?
I think the first thing to actually do is step back and think about why we find everything expensive. I mean, you look at PE ratios for stocks, they look high. You look at cap rates for real estate, they look high. You look at pretty much every asset class, that's what leads us to expensive. But they're all driven by the same force, which is if T-bond rates are 2%, everything's going to look expensive. So rather than think about all the asset classes, the question we need to ask is, what's a fair interest rate? Because if that fair interest rate is 5%, and it's set at 2%, then you have a bubble that's across all asset classes, and there's nothing you can do to escape that bubble, right? I mean, maybe you can convert it all into cash, but even that, I'm sure, is not going to be protection because it depends on when you think the bubble will burst. Yeah. So I think that becomes the core of the question. Is a 2% interest rate too low? And if you ask that question, the answer you get from most people is, of course. And the vehemence with which they say, of course, will depend on how old they are. The older you are, the more convinced you are that 2% can't be right. It just looks too low. I call it the hubris of normalization, which is we normalize based on our experience, which is if you've been around 40 years and I ask you what's a normal T-bond rate, you say about 5 to 6%. If you've been in the market 20 years and I ask you the same question, you say it's 4%. If you've been in the market 5 years and I ask you what a normal T-bond rate is, you say it's about 2 to 3%. So I'm a little wary about what a normal interest rate is anymore because I think we've entered a new phase in markets, which is we're seeing the flip side of globalization. The flip side of globalization is I think you're going to have lower real growth, lower inflation, but you're going to have a lot more rolling crises. Every 2 or 3 years, you're going to have a macro crisis. Or put differently, risk-free rates are going to stay low, but risk premiums are going to get bigger. So when you look across asset classes, that's the question you should be focusing on is rather than worrying about the base, is the rate too low or too high, which is something we can't answer. Ask yourself, am I getting enough of a risk premium for investing in equities, for investing in bonds, for investing in corporate bonds, for investing in Asian stocks? Because if you can answer that question for yourself, then you're going to be okay investing in these asset classes. Yeah.
So let me ask then, do you think investors are getting enough of a risk premium for investing in U.S. stocks right now?
I think so. In fact, that's why I compute that equity risk premium at the start of every month. Because to me, that is the canary in the coal mine, is when that number gets too low, then it's a warning sign that stocks collectively overvalue.
And you haven't hit that warning sign?
I haven't hit that warning sign. The equity risk premium at the start of this month was 5.7%. The historical average for the equity risk premium is about 4 to 4.5%.
And what about Europe? Are there any markets where you look at where that index has got a kind of a flashing green light that says buy for you right now?
Probably Southern Europe across the board, right? Because people are, I think that's one of the problems with these rolling crises. When you have a rolling crisis, that part of the globe tends to be contaminated by that rolling crisis. So whether it's Brazil pulling down Latin America or Greece pulling down Southern Europe, that's where your bargains are going to be. One of the benefits I have is I don't invest in asset classes. I invest in individual assets. So as long as I can find a reasonably priced company in these markets, I get a double whammy. If the asset class is underpriced, I get that increase in the asset class. But even if it's fairly priced, I'm okay with that investment in my portfolio. Because if you're buying individual stocks, hoping that the market is going to drag them up, then you're probably wasting your time and resources. You should just buy an index fund or a particular, or the entire sector, right? So to me, that's my defense is I am very bad at calling, at being a market timer. I don't know whether there's a bubble, when it's going to burst, and if I stay waiting for that certainty to happen, I end up out of stocks for the rest of my life.
Good. Thanks, Professor.
Welcome.